Welcome everybody. Welcome to Real Talk with Reggie, where real estate meets real life. And we want to thank y'all for being here today. I have an excellent panel. I have Tyrone Eugene from Century 21 Envision. I have Brian Creighton with the Century 21 Envision Creighton Group. And I have Billy Saunders from Gud Mortgage. I want to thank you all for coming today. And our job is to send you all or give you all information to make an educated decision. First and foremost, giving honor to our Lord and Savior Jesus Christ. Thank you for having us here today. And the topic today is government programs and grants available for first-time home buyers. Okay, so we want to jump into it. So holler at your boy. Yeah. Billy, we want to start with you, buddy. What are some of the popular government loan programs, government-backed loan programs? And what's the difference in the loan programs?
Well, when you think about loan programs, there's basically 5 different loan products that are available to consumer programs, to consumers. Right. You've got your VA loan, which obviously we know that's designed specifically for our military veterans, right? Mm-hmm. In some cases, spouses of military veterans who, and there are scenarios that they are eligible as well. Right. Then in addition to that, you've got an FHA loan, which is a government-backed loan program, and a USDA loan, which is a government-backed program. Mm-hmm. Then you have your conventional loans. Conventional loans are typically Fannie Mae and Freddie Mac sponsored. These are ones that are privately funded loans, but have some government involvement as well.
That's what I was getting ready to say, because some people think that they're not, but they are.
They are. The government's in on everything.
Yes, exactly.
Our industry is very regulated by the federal government across the board.
Right. How can buyers find out about state and local grant programs in the area?
Every state has their own programs and product offerings, and I think most people do the same thing. They all go to their Google machines and they search for the programs. But, unless you're really well versed and you know where to look, it can be a really confusing process. So what I always suggest is reach out to a local lender, somebody like myself, and we've got just an immense knowledge of these programs and product offerings, and we can better be in a position where we can guide our clients as to certain eligibility factors, because there are a lot. I always laugh. Sometimes I say you got to have one green eye and one blue eye to qualify.
Right.
Yeah, there are what credit score requirements, right? Yes. We all know that. Typical credit score requirements for most of the government secured programs, especially the down payment assistance programs, are going to be a 640 or higher. Okay. There are debt to income ratio requirements. Mm-hmm. In some cases, there's income limits where you can make too much money and not qualify, which is really counterintuitive for everything that we think about when you're giving money to a consumer to buy a house. Right. When they hear that they make too much money and they might not qualify for a USDA loan, so to speak. Right. That really is a little confusing to somebody, because again, this kind of goes against the grain of what you would think would be natural when qualifying a buyer.
Yeah, and we're going to get back to that, the credit score and the income. I want to ask you, how do government programs help reduce the financial burden for the first-time home buyer?
The FHA loan in particular, in most cases, has a lower interest rate than a conventional loan. Right. There are mortgage insurance premiums that are applied to a FHA loan that could be more expensive than a conventional loan. Mm-hmm. So they kind of wash out. It's funny that you're bringing this up, because for years, the gold standard was conventional financing. Mm-hmm. It's not that way any longer. Right. Now, sometimes there are scenarios where you may have a higher qualified credit score buyer that might actually get a better mortgage deal for himself using FHA over conventional. And there's various sundry reasons as to why that may play out. And, every scenario is different and unique and specific to the buyer and the consumer. So we always look at every option just to make sure that we're delivering the best program to the consumers.
Now, for some people that don't know, go a little bit deeper into the mortgage insurance.
Okay.
Yeah, you say MIP, mortgage. Some people don't know, so we're trying to water this down and put it in layman terms.
A lot of people think that mortgage insurance premiums help them in the event that they die, that they think their mortgage is going to be paid off. Right. That is absolutely not the truth. Right. In most cases, mortgage insurance premium is about risk mitigation. It's really designed to help protect the bank or the federal government, for FHA, to collect the mortgage insurance premium up front and also monthly. And what that does is that money is kind of held into like a secondary account like a bank, that in the event that there is defaults or mortgage foreclosures, the agency or the banks can use that money to help offset and mitigate their losses.
Good. And that's something, because a lot of people don't understand that. Yeah. So we need to break that down, because again, we want to put out information that's going to help everybody that's watching us today. Okay.
So the formula for an FHA loan, the mortgage insurance premium is always going to be the same it's the same calculation based on the percentage that we allot. However, for conventional financing, this is one where the higher the consumer credit score and the more money that they're putting down can actually make the mortgage insurance premium less.
Gotcha.
So there's differences, and that's why working with an experienced and knowledgeable mortgage loan officer who's willing to do
You are yourself.
Absolutely. Thank you so much. Who's willing and able to do a little bit extra work just to give the consumer a side-by-side comparison so that they know that they're making the best decision for them.
Okay, so let's go a little bit deeper. So with the percentage as far as the conventional and the FHA, there's always the information that with FHA, the MIP can drop off.
That's correct.
Okay. Now, is that true now?
No, it's
No,
not
yeah,
true.
yeah. Okay. And let me set the record straight. Years ago, if you had 80% ownership in your house, then the mortgage insurance premium would drop off.
Correct.
Which can be anywhere, depending on the price of the house, $200 to $600 a month. But now the laws have changed. Can you just talk about that a little
Yeah, a
bit?
few years back, and I'm throwing a blank exactly what year, I think it was 2017, the FHA basically rewrote their manual to say that mortgage insurance premiums were going to be permanent. So if you purchase your house, actually I think it's 2011 or beyond, then and you have an FHA loan, the mortgage insurance premium that is imposed by the Fair Housing Administration, FHA, is going to stay with that loan forever until you either sell the house, pay the house off, or refinance it into a conventional loan, and you have enough equity, as you mentioned, that 20% equity, 80% loan to value, and then at that point it can go away. However, with a conventional loan, it's very different. It's still for conventional loan, conventional financing. Once you accrue that 20% equity in the property, you can apply to have your mortgage insurance premium removed from your monthly payment.
Got you. That's important because a lot of people don't know that now. Because back in the day, they used to drop off. They used to call us and say, "Can I hear your CMA?" Everything. Let's put it in the CMA and go from there. Now, a lot of times, especially with first-time home buyers, they get scared of all the paperwork and documentation that you need. Can you just go through some of the stuff that you need so we can help them be more prepared when they come to you?
It can be overwhelming.
Okay.
And I try to present this task list to a consumer in a way that they understand the reason why we're asking for what we need, which typically are going to be it's going to be a grouping of documents ranging anywhere from bank statements because we need to verify your assets, pay stubs and W-2s because we need to verify your income, driver's licenses and identification because we need to verify that you are who you say you are. And then outside of that, sometimes we go a little deeper. We need to get verification of employment from your employer, especially for those buyers who operate with their hourly rate employees and they get overtime, or maybe they have special pay, like a lot of times nurses have night differential and things like that. And then in addition to that, if you're self-employed, we ultimately need to do a deeper dive. We're going to look at your actual tax returns. And we typically need at least 2 months worth of bank statements, 2 weeks worth of pay stubs, 2 years worth of W-2s and tax returns.
Okay. So look, let's go even a little bit deeper because now most people find it a benefit, which it is a benefit to start your own business and self-employed.
It can be.
Yes. Okay. When it comes to buying a house, a self-employed person come to you and say, "I want to buy a house." What do they need to bring to you?
Well, first and foremost, I'm going to need the tax returns. One of the benefits of being an entrepreneur is that you can legally kind of work around the tax implications and be able to write off expenses and not have to ultimately pay taxes on all of your earnings. Whereas now that's great, except for it works against you when you're trying to buy a house. Because just to use round numbers, if a consumer, a self-employed entrepreneur makes $100,000 a year and they have $90,000 worth of expenses, then that means I've got $10,000 worth of what I call usable income to qualify them to buy their $450,000 home, which isn't going to happen. So what we typically need with the entrepreneur is, with all cases with entrepreneurs and self-employed consumers, we need to have at least 2 years of a business existence. We need to be able to show that they've been operating for 2 years because we know that businesses fail, and if they're going to fail, they typically fail in the first 2 years. So we need to be beyond that point, have 2 years worth of filed tax returns, but we need the returns to be filed in a way that shows that we have usable income. So that same entrepreneur is going to have at least 2 years worth of income in which they're paying taxes, and then on all of their earnings, and not writing off expenses and losses and things like that, in order for us to be able to, really realistically help them to move forward.
Now, with self-employed also, I've had the experience where even when I've had clients that it's been recommended that they amend their taxes.
Right.
Do you have situations like that that helps that situation?
Underwriters are pretty smart.
Okay.
And they know that you can't really amend your tax returns just for the benefit of buying a house. You've got to be consistent with the filing and make sure that you're doing it in a way that's not just to be beneficial just for this purpose. So again, it goes back to that 2-year window in my opinion.
And that goes back, Tyrone and Brian. We come across clients all the time, and the first thing they say is, "Oh, I can't afford it. I don't know where I'm at. Let me wait till this." My point, and I'm sure y'all tell them too, go see the loan officer first. And they can go ahead and put together a roadmap from getting you from A to Z. Do y'all come across that a lot?
All the time. I always tell them, the first thing I tell them, they say, "Well, I don't know if I'm ready. I want to pay this off first," or they want to do certain things. My thing is, before you do anything, talk to your lender. Because a lot of times we look at it in the standpoint from, on the consumer side, we're looking at like, hey, let me pay all this off and do this. Well, there's some things that we may be paying off. They don't need to be paid. It don't even matter to them what we're paid off. So always tell them, talk to your lender first. And so that's the
Let me put them in front of Billy. Let me put them in front of.
Absolutely. Call Billy and ask him. He'll tell you what it is that you need.
Correct.
I mean, he'll say, pay this off. It may not even need to be paid off. It could just be a thing. You just need to take care of this much of it. Right. So I always have them call first.
To that point, I think the biggest detriment that I see a lot of consumers that want to buy a home and they want to go through this process, they wait until they find the home that they want to buy to start the process. And that
You're behind the heroin.
And you gotta watch yourself too, because when we do our consultations and stuff, some people can be pretty headstrong, and we have to let them know, hey, look, if we don't do it this way, then it's going to cause us a lot of time and effort later. Okay, so we got to make sure as realtors and brokers that we give them the correct information when we consult them at the beginning in order to make the process a little bit smoother. And everything, because I know that's important. Okay,
Setting them up for success.
Exactly, because time is money, and we don't want to waste their time as well as ours.
And then speaking to time, what do we all know? Real estate happens what? Fast. Right? Real estate happens fast.
Correct.
We don't have time to go through a pre-approval process with somebody, and when you're trying to get your contract offer written and accepted. I mean, that window can be short. I went through it yesterday with a client where they wanted to go look at a property. We've been trying to get this young gentleman, this young man to apply probably for the last 4 months. Now all of a sudden he found a property. It's very unique to the type of home that he wants to buy. It's got a blockage already on it. And he's like, I want to move quick. We got to get this done now. I'm like, I wish you would apply.
Exactly.
Even a couple of days ago.
Yes. But then that goes back to us saying, hey, I can't take you out until you do your application. You know what I mean? Because on a part of that contract, it says doing the application within such amount of application already done. The age was 0 in there. Okay. But usually now I'll put 21 days for the commitment letter. Okay. So that is important for us to make sure that we lead our clients down the right way, because it saves our time.